For the past 18 years, I have lived and worked in developing countries. I've learned a lot about how people live their day-to-day lives. I've seen how access to information and services, things that we take for granted, can fundamentally improve the life of a poor person or anyone really living in a developing country. This is especially the case when it comes to financial services. Now tonight, I want to tell you about a place that's especially close to my heart. In this country, about a quarter of the population relies on informal financial services, money lenders, short-term loans, to maintain their financial lives. Let me tell you about this country by introducing you to two people who live there. Let's call them James and Karina. They have a young kid, few jobs between them, they juggle jobs. Only one of those jobs provides a regular monthly income, the others are short-term, seasonal. That poses a challenge because, like many of us, we have bills to pay. They have bills to pay. They have their apartment, car, school fees, food. They spend a lot of their time managing their financial lives. Now, in the past, they had a bank account. Bank accounts can be those buffers, savings accounts. But the bank was really far from their house. They had some fees and unexpected charges, and as a result, they said, forget it, we're not going to bank anymore. But they had some outstanding fees, didn't pay, they got blacklisted. What that means is in this country, they couldn't get a checking account. They couldn't open a savings account. They were sort of stuck. If they had the single car they share to get to work, if it broke down, well, what do? They go to a money lender. They're all over the world. I'm sure you've seen them here. Strip malls, the big flashy neon signs that say, get money here, no approval process. You know what? Those can cost you a lot. I'll tell you why. Well, first of all, they cost a lot. They need $500 to fix their car. I'm sure you've all been in similar situations. You're going to have to repay $575 back in 2 weeks. So the first element of this cost is that's nearly 400% in annual interest that you'd be paying. But it's worse than that, because often when someone takes out a loan like this, they can't repay it in 2 weeks. They got another loan to pay the first loan, another loan to pay the second loan. This cycle of debt that puts them in a really bad position. As a result, in this country, the average person who relies on money lenders spends $2,400 on fees and charges and interest alone. To put that in perspective, that is roughly 1 month income for this person. That's crazy. Now, where do you think this could be? Sub-Saharan Africa, maybe Southeast Asia, Latin America? Short answer, it could be any of these countries. But guess what? Look around you. I'm talking about the United States. These are real facts for the way people live their financial lives here. In Oregon, 1 in 5 people live like this. In Washington, where I'm from, it's 1 in 4. Now, you may think, doesn't apply to me, everything's stable, got a good life, got some savings, but guess what? Only about half of the US population has more than 3 months of accumulated savings. You know what that means is that if there is a health shock, for example, and health shocks, by the way, are the single largest source of personal bankruptcy in the US, or other unexpected big cost, then you're going to be out of luck. If you can go to a bank, that's great, in some cases. In others, you need to go to a money lender. So take a look around you. Person on your left, person on your right, you. At some point in the future, one of those people will likely be relying on money lenders. Now, conventional wisdom says banks are there. They're on every corner. Wells Fargo, Bank of America, they compete with Starbucks for those cherished corner locations. And you know what? They actually offer a form of short-term loan. They don't really advertise it like that. They call it an overdraft fee, or my favorite is a courtesy overdraft. Courtesy, right. Yeah, I'm sure no one here has ever seen one of those pesky $35 charges on your account, right? No one in this room. Well, you know what? Let's say you have an account at Bank of America. I bet some people do. And pure accident, you overdraw by $100, but you can't pay it back for 2 weeks, 10 days. 10 days from now, you're going to owe $170. $100 overnight, 10 nights, turned into $170. That is an annualized interest rate of over 2,500%. Talk about crazy. Now, what really gets me is to really understand how much banks charge. You'll have to look through the full disclosure statements, right? I don't know if anyone's opened an account recently, they give you this book. It's really a book. The average number of pages in disclosure statements for checking accounts in the US, who can guess? 100. 100 pages. Who reads that? It's crazy. So as a result, in 2011, Americans paid, ready, $38 billion in fees, charges, interest on overdrawn checks. $38 billion. That is 10 times the city budget in Portland. That's 1.5 times the total revenue of Nike last year. That's more than the federal government spent on Pell Grants. So look, we have a big problem on our hands. Let me frame it this way. 1 in 4 people rely on these informal services, and they tend to be people who are disproportionately hurt. They don't have the same means. They're lower income people in general. And nearly 1 in 2 don't have a financial cushion. So while you may feel your finances are strong, you may have a bank account, your friends may all have bank accounts, life happens. And when life happens, you may have an unexpected expense. Remember, 3-month buffer isn't that much. And you may rely on informal financial services as well. Now the good thing, the exciting thing, is that we're at this point of time when disruption is about to occur in the financial services sector. What am I talking about here? I'm talking about 3 factors, a confluence of 3 factors today that will transform banking as we know it in the United States. It will transform how you do your banking, how you save, how you earn money, how you spend money, how you manage your money. Factors are simple. The first is that today there are appropriate products. There are products that Karina can use to manage her finances of her family. They just haven't scaled. Key to scaling? In everyone's hand here tonight, I bet, a mobile phone. That's where the second factor comes in. Behavior is shifting really quickly in terms of using phones to access financial services. I have a good example in a minute. And third, and this is the real game changer, innovations from developing countries are proving that lower and middle income people can be served effectively in a way that's completely different from using bricks and mortar today. Let me give a few examples. There's a place in Seattle called the Express Credit Union. Now, there are a bunch of other similar financial institutions around the US, but I'll give you some examples from how they do things like payday loans. That same $500 that you may need it to fix your car, you don't need to pay it back in 2 weeks. You have 90 days to pay it back. And you can pay it back with flexibility over the course of that 90 days. Second big difference, if you go to a moneylender, best case is there's no effect on your credit history. In other words, you paid it off. In most cases, you can't pay it off as a ding on your credit record, you just go further in the hole. By taking out one of what they call an alternative payday loan, you're able to boost your credit history, making you more creditworthy in the future. The third point, and this one I like a lot, is that if you pay back your loan in fewer than 90 days, they give you 1/3 of the money back in savings. And savings really matter. Remember that cushion? Remember how hard it is to save? We all know how hard it is to save. But they're putting incentives in place to encourage people to save. Let me give an example there. Save to Win is a program. It's available in a few states. The way they implement it is it's basically turning the lottery on its head, which I love because lotteries themselves are so regressive. If you put in $25 into an account, you get effectively a lottery ticket. It's a savings account. You can put in as much increments of $25 you want. You get more lottery tickets. You get cash prizes out of this. This program has been very successful. The average savings account, that's a Save to Win account, has 5 times more savings in it than a traditional savings account over the same time period. So let's look at where we are. These are 2 examples of products that, if spread widely, payday loans wouldn't be necessary anymore, first of all, and I think there'd be a lot more saving, second of all. Both of these things are really important, especially for middle and lower income people in our country. Now let's look at that second factor. The only way to scale, I think, is through the use of mobile phones. So we're going to do a little audience participation. Everyone, take your phones out. Got them? Turn on the screens. And I'd like you to look at the screen. Hopefully you'll recognize a few of these logos. Now hold your phone up in the air. Come on, hold it up if you have any of these services on your phone, okay? Any of these services at all. Now keep your hand up if you've used one of these services in the last week, okay? Keep your hand up if you've used it in the last day. All right, thank you. You can put your hands down. So here's what I saw looking at the audience. First, a lot of glowing screens, which I appreciate. There are two big shifts that I've seen in terms of behaviors and in terms of using phones in ways they haven't been used in the past. One is I ask this question a lot, and I uniformly see that there's this big ramp up, this acceleration of using phones to access financial services in ways that they weren't used in the past. Second, and this is what I think is really interesting, that it's, look at this screen. I didn't put banks up here, but these are the guys on the screen who are making the biggest difference. They're the disruptive innovators. Let me give you an example. The one in the middle, Starbucks. I'd imagine some of you are familiar with the Starbucks card. It was launched as an app about 5 years ago. Since then, it's grown rapidly to become the largest mobile money network, a closed network, in the United States. Starbucks, not a bank, Starbucks. Now, they process nearly 1 million transactions per day by people holding up their phones at the register. That represents 15% of their annual revenue. That's huge. Now, what's even better, in my mind, is that when you're standing in line or you're just waiting for your drink, you're watching other people, right? You're seeing people pay with their phones. That's changing behavior. That's a nudge. A small nudge is what it takes to get people to change behavior, and people are increasingly using their phones. Now, the downside of Starbucks, in my mind, is that not everyone can afford a $4 latte. Not everyone wants a $4 latte. The good news is that there are a bunch of companies, some of whom you may recognize on this screen, that along with 24 other companies, large retailers, that are squarely focused on middle and lower income people who are taking a page out of Starbucks' book. In the next few months, we'll be launching a program to redeem coupons on your phone, have rewards validated on your phone, and, yep, pay with your phone at over 100,000 locations across the US, just when they roll out. This, I believe, will fundamentally shift the way that people perceive phones and the ability to use phones in ways that they didn't think about before. So let's see where we are. We've got products that exist. We've got behavior that's shifting. These are conditions that are necessary, but I don't think they're sufficient. They'll bring about incremental change, but not innovative change and disruptive change. Why? Because this innovation thus far has really been focused on the $4 latte crowd. It hasn't been aimed at or tailored to the needs of lower income people. Let me tell you where that disruption is going to come from, which is my third point, when you look outside of the US. Let's call this gentleman William. He's a farmer in rural Kenya. He lives one day's walk from the nearest bank. Most of his life, he never had any interaction with financial institutions. He represents disruption in financial services. Why? Well, you look at his income flows, they're not that much different from someone like James and Karina. That makes his life tough. But now, he has a bank in his hand. What do I mean? It's that phone. It's a $30 phone. Some of you may have seen them. They're really popular in developing countries. They have a little LED light on top. It's a flashlight. People use that more often than the phone itself to find their way around. Well, now he uses it as a bank. What do I mean? Well, to start, he can get a remittance, a payment, cash basically, from his son who lives in Nairobi with an SMS, just like that. He can develop credit, something he's never had. How do they assess his creditworthiness? Based on how much he uses his phone. He can then access credit. He can now save on his phone. So he can save when he has more money, not under his mattress, but in an interest-bearing account. And get this, he can get life insurance through his phone, provided that he spends a certain amount every month. And guess who provides it? When I say spend a certain amount, spending it on airtime on his phone. Guess who provides it? The mobile operator. Here's a clear parallel with the US. It's the mobile operators that are innovating and disrupting the way financial services are delivered. They're enabling the delivery of financial services in developing countries. In Kenya, a mobile operator launched M-Pesa about 5 years ago. Over this period, there's been a 50% increase in the number of people who have bank accounts, most of that driven by M-Pesa. And this isn't just a Kenyan thing. Uganda, Bangladesh, the Philippines, Ghana, these are a few examples. Across sub-Saharan Africa, Southeast Asia, in 9 countries, there are more mobile money accounts than bank accounts. So where does this leave us here? We are at, I think, a unique and really exciting time in history. We have the opportunity to fundamentally alter the economics of delivering financial services over the phone. We can disrupt banking as we know it today. We can meet people where they are and how they live their lives. To do that, we need to begin by building for an $80 phone. This phone is $80 in East Africa. If it were here, I think it would be about $50. Not the $700, $800 phone. That's how much most phones that a lot of people in this room have if they didn't come with a 2-year contract. Second, we need to enthusiastically embrace innovations, new services, approaches, products like savings accounts and checking, equivalent of checking loans that are coming from developing countries. So if we do this, let's take a look at what the future will be, coming back to our friends James and Karina. So it's a few years from now. Their financial situation's improved a little, but they still have this imbalance between the money coming in and the money going out. But now they also have the bank in their hand, at the tip of their fingers. They can access account information and do budgeting on their phone. They can build a credit history by the use of the phone and other factors. Based on that credit history, they can access credit instantly. They can send and receive money, how? Just by knowing someone else's phone number. They can access education, make well-informed decisions about how to live their financial lives. And did I mention? This phone is free from the financial institution, provided that you put at least $25 into savings every month. The world is changing here. The physical banks, they're not necessary. They won't be necessary. The phone will be in the bank will be in people's hands in the form of a phone. Now, I like to take pictures of my kids when we come across a payphone, in part just because I like them to remember that payphones existed in their lifetime. Now, you may be aware that in places like New York and other cities, they're actually turning payphones into wireless hotspots, which I think is really cool. Now, this serves as a really powerful metaphor, the payphone turning into a wireless hotspot. Think about all the bricks and mortar that's out there, all those banks that can serve a similar amplifying function. They could serve a function in the future as financial empowerment centers, giving people the tools and the knowledge they need to live their lives in a much more financially independent way. So the next time that you're in a bank, take a look around, look at the posters, look at all the people in the bank, look at the infrastructure, the couches. It's a nice place. And ask, what is really necessary here in order to conduct financial transactions? What do I really need here, and how much does it cost me? Then take out your phone and take a look at it. Think about how you can be an early adopter, how you can offer a peer-to-peer loan, or how you can bank without a branch, or how you can make a payment on your phone. Everyone in this room can be a catalyst for this change, and it's a change that our society as a whole will really benefit from. Thank you.